Good morning.
Let's get right to the opening bell on this Thursday morning at the CNBC Real-Time Exchange. And the big board today celebrating its IPO, commercial washer and dryer manufacturer Alliance Laundry Systems at the NASDAQ Ford Industries, a Lana Treasury company. Mike, as we will try once again, I guess, at this 67.50 is strange, been a little stubborn.
We've hesitated a little. Actually, in very much the way we did before 6,700 last week, so that didn't really hold. It's been, I wouldn't say narrow, but it's been uneven and selective in terms of day-to-day, whether we have kind of broad participation or not. One of the sub-themes I think has been interesting is consumer sentiment surrendering some leadership. Various parts of retail, travel, obviously home building. Maybe you're going to get a little relief on that trade today. I think that the Delta Airlines numbers and then Costco same-store sales were a theme as well. Maybe it's going to give a little bit of relief to that trade. But that's been one of the key things. For months, you've been able to say, hey, everyone's concerned about the job slowdown. But look, consumer cyclicals and industrials are doing great. Industrials consumer discretionary a little bit less.
Right. Other big earnings print, of course, is Pepsi today, up in the pre-market. Some disappointment on margins. Sales were a slight miss. I think North American food was a little disappointing.
Yes.
We'll talk to Ramon later on today.
Yeah, I mean, it's an interesting spot for the results, meaning very discounted stock relative to its own history and to the market. Never been cheaper versus the S&P 500. The gap below Coke's valuation is also at a historical extreme. It's under 17 times forward earnings. The benefit it used to get from being exposed to the snack business is now seen maybe as more of a liability versus Coke. So maybe the bar is pretty low in terms of improvement. They obviously also are getting a CFO succession.
Yeah, from Walmart US, right? Steve
Exactly.
Schmidt.
So, maybe a little bit of firming up. Staples have just not shown much life at all. So maybe we'll see if that does change because, as much as you would say, well, home building and travel and retail hasn't really held up as well, it's not to the benefit of Staples yet. Although keep in mind, Costco is also in the Staples sector, at least technically.
Yeah, mortgage apps were a disappointment earlier in the week, and you mentioned home builders, I think, near a 2-month low at this point.
Yeah,
some of the home improvement.
And at least you have to squint a little bit and say, well, the long end of the Treasury curve has actually been subdued. You've had yields come in just a little bit. Mortgage rates are not back on the rise just yet. So, has the link been broken, or are we just sort of dealing with an overhang? The prices have softened up in a lot of parts of this country. I know you also flagged an article about an uptick in foreclosures in some regions.
Yeah, foreclosures, I think, up 20% or so year on year.
Yeah, off a low base and everything else, but affordability where it is, it's a locked up market. So home improvement retail has also struggled along with that. Again, it could just be a stutter step, and I think one of the big debates, or two of the big debates, is the softer labor data disconnected from a strong GDP trend at this point? In other words, are we making it up elsewhere, affluent consumption and corporate capex? And similarly, everyone is taking comfort in really tight corporate credit spreads, and people say, it's really not showing you much stress. Is that reflective of the overall credit picture, given how much is in private credit and given some of the hiccups we've just seen in some of these bankruptcies? So I think those are two things, like these core bullish talking points that you have to at least say, are they being challenged from one direction or not?
One of the key bankruptcies, so to speak, to the extent we've had any, is of course the Sprint brands, which has been having a residual impact on the likes of even Jeffries.
Yeah.
There's a fund that Jeffries had some money in. It may have been overblown, but you can take a look at Jeffries shares. Still down. I mean,
They were down quite a bit yesterday.
Yeah, down quite a bit yesterday. This after strong earnings a week or so ago, remember, and usually a forward gives us a nice snapshot in terms of the capital markets activity and what we can expect from the likes of Goldman Sachs, JP Morgan, and others when it comes to that part of their business. But as specific to Jeffries and its exposure to First Brands, they did put out a release. And then you've got a couple of analysts weighing in as well, Mike. I took from the Goldman note here. Two exposures. This Point Bonito, it's kind of like a factoring fund. They take in the invoices and they give the money first. But I mean, by the way, when you got a Walmart invoice, it's pretty good money that they're going to pay. But the money that they had in there, how much that was, about $115 million or so. But ultimately, you can see both Morgan Stanley and Goldman come to around a $45 million exposure, or a 5% hit to EPS if, in fact, they were not to get anything back. That's the potential loss that they see.
And it's an auto parts supplier. It was sort of it seemed like a one-off, but definitely tariff affected on some level in terms of the core business. And I think it's much more about, this is sort of coming, from a blind spot that people had at this point, and you just don't know if it's going to be followed by others. When it comes to Jeffries in particular, they have had pretty good results, but they also, for a decade or 15 years, the stock traded at a slight discount on average to book value. It was kind of just trading at book value. After the election, it ran up to 1.6 times, 1.5 times. It was riding the strength in capital markets activity and expected capital markets activity, and it's just backing off of that. I mean, that's the way I would see it, where it's kind of just, all right, maybe we got a little bit too excited about the value of the franchise today. It's not so much that this is going to be punishing in terms of losses.
Journal takes a crack at drawing a line between tariffs and trade uncertainty and firms that were just over-leveraged, and they mentioned Tricolor and First Brands. Barron's took a look at overall these so-called non-depository financial institutions. Their share of C&I loans are like a third.
Yeah,
it's a $1.5 trillion in loans.
Exactly.
Yeah.
And I think it also it bleeds into regional banks have they've backed off a little bit. It's not as if they're people are sort of spotting specific problems, but it's just about on the margins. Is it or do we have to brace for something that's a little bit more in the way of adverse outcomes?
Guys on earnings movers wanted to come to Ferrari because the shares are down over 12%. And by the way, its market cap is still $100 billion, which is in excess, of course, of Ford or GM. You can take a look, though. Guidance came in lighter than had been anticipated. Now a lot of focus on the third quarter in terms of will there be price support for the shares there. You're talking about a multiple that this company gets that is so
like
far
40 times forward.
Yeah, exactly.
Yeah.
40 times forward. And so you do get, when they pull in guidance, they've also cut back on their electrification plans, at least in the near term. And so you do have a number of analysts certainly questioning, all right, what is the multiple given that? And where are we in terms of 2030, ultimately, the rollout and what they look like in terms of forward guidance for the next few years being perhaps less than had been anticipated?
They intentionally restrain production. This is a truly scarce luxury good, right? Where there are fewer than 20,000 a year, I think. The secondary market for them is incredibly strong. People pay enormous amounts for it. So I guess if you're an investor saying, why don't you maximize growth, you're looking for further incremental production. You want to get bigger scale. And the company doesn't really seem to want to do that. They're maintaining a more measured view. And again, on the electric vehicle part, that's a little bit controversial as to whether the customer base wants an EV.
They do cut their EV target roughly in half.
Yeah.
And a lot of the weak guidance is on the far end, 2030. But look at a 1 week of Porsche. Look at a 1 week of BMW.
Well, that's exactly it. Yeah.
Race is going to join that party. So it's a lot of these European automakers. And they're not really citing tariffs as a source of weakness in the U.S.
They're not, no. But no, and they did. Yeah, the results were just like short of estimates pretty much globally, actually, in Europe as well.
Tesla, meantime, is a story. There is this piece on the wires about NHTSA opening a probe into almost 2.8 million vehicles that use FSD for some what they think might be some traffic safety violations. Some more commentary about Musk's proposed pay package and how he might still be able to earn billions even if he misses some of these targets.
Yes. So, I mean, obviously the headline was the $1 trillion potential payout. That's if you meet these massive stretch goals about market cap and such. Yeah, but the cumulative production or cumulative sales of vehicles from day one, what is it, 20 million? I mean, some of those seem like they're built more to, clear those hurdles. And, I don't know, it's $1.5 trillion market cap now. And so tens of billions, maybe it's not a big deal if that's what your, the cost of retention. Because it is, this reflexivity is incredible. With the more people believe Musk is going to be focused on the company and he's going to continue to, kind of hype the story, the more the stock goes up.
Right. You mentioned NVIDIA earlier. Cantor today goes to 300 on NVIDIA, which is about 27 times $11 for calendar 26. We were talking earlier.
Yeah.
A $300 NVIDIA would take market cap to
7.2 trillion thereabouts, 7.2, 7.3 trillion, assuming the share count remains where it is. So, it's a big bite from here. It's obviously almost 40% upside, or something like that. So, I don't know. I mean, it's really actually kind of interesting how NVIDIA has been a much more orderly climb. It's at 190. We got there a couple of months ago. I mean, last year we had like a 5-month period when it went sideways. So the numbers are huge. Everyone pretty much thinks 2026 results are in the bag. They're pretty high visibility on those. And, Jensen Huang was around talking to investors in the last week or so, and this is kind of everyone's freshening up their take on what they can do.
Gets us to TSMC, which we mentioned briefly at the top of the broadcast. Of course, NVIDIA designs the chips, and then they are manufactured largely, still, maybe even entirely the highest-end chips in Taiwan, which gets obviously some of the key geopolitical concerns that reverberate here in terms of our manufacturing capacity. But I mentioned TSMC as well because September year-over-year revenues were up 31.4%. They did decline month to month from August to September, 1.4%. But generally speaking, quite strong. They continue at TSMC, which is the dominant manufacturer of the highest end chips for the likes of Nbhd and many others, and certainly does have plans underway here in the States, but we've heard various things in terms of the ability actually of those fabs in Arizona
Yes.
to be able to manufacture at that same level, so to speak, as they do in Taiwan.
And really the whole food chain has just really started to accelerate and participate on it, right? The memory chip area, the South Korean companies, everything. It's kind of like there's just not enough of the stuff. And that's the amazing part of this. And even really relative to some degree to the internet bubble, where it is really, you're building structures. It's just hundreds of billions of dollars in capital to create real assets that depreciate quickly, but they're real assets.
Because the chip generations are so short.
Yes, and that's one of the bear cases, which is like, oh, you're going to lever up the data center construction, and they have like a 2.5-year depreciation. And actually, part of the counter to that is people say, yeah, but the useful life is much longer. Like for the core weaves and such. That fine, we have to write it down over time, but yet they still retain value for a longer period of time.
Well, that's a key. That's a key question.
Yeah,
that's a key question, particularly when it comes to core weave. And we've talked to Michael Intrater, the company's CEO, about that, because so much of the financing is based in part on the ultimate value of those chips and how they depreciate them over what period of time.
I think the sell side is on the side of, now you're actually still going to retain value past that point, but who knows?
Who's going to? I don't know what they're. I mean, I guess are they still good for inference if they're not for training?
I don't know. That's the thing. Yeah.
And what supersedes them, and what comes next in terms of efficiency?
World of scarcity continues for that long.
Right.
That's the other.
And again, there are.
That's the only way. That's the only way. And you get from Andreessen $100 something costs 100 today, costs pennies tomorrow. That's the only way it gets there.
Yep.
I guess.
Yep. But I mean, there are no shortage of potential competitors, obviously, in far different.
I'm in Nbhd, which is in another screen.
Whether it's the Grok of the world,
Sorry about that.
had two of these companies on.
But I
And then
can't
Broadcom,
change the screens right now because I'm keeping an eye on ES as well.
with OpenAI, it's a $1.6 trillion market value. It's not up today, but I only mention it because it's basically nipping at the heels of Meta. And it's, so I don't know at what point we start to include it in the.
This is looking strong. Nvidia might make a new high.
It's the 8, or you got a 10,
or 10.
And also, I mean, Tesla is there for size, but it's not really reflective of the rest of it. In terms of the profitability and the other dynamics of what's driving the business.
We are going to, speaking of all this, watch Alphabet today as they roll out Gemini Enterprise. A fascinating piece in the journal about Microsoft trying to establish, I think they called it within Microsoft, urgency to build up a measure of technological independence from OpenAI. This sort of rolling, some call it a divorce, slow-moving divorce between these two giants.
It is amazing, and OpenAI seems
There's no market participation.
But just to portray itself as having the kind of blocking position. They have the head start.
Nvidia is going against the market. Nvidia is going to retest all-time highs.
Future scarce assets that are going to be out there.
And
does that ultimately lead to redundant spending and overcapacity? That's the
You have to give OpenAI credit and Sam Altman in the sense of it wasn't that long ago that they were seen as almost being entirely dependent on Microsoft and the goodwill of Microsoft to continue to fund them, and that has changed dramatically, even in just the last few weeks.
What did ChatGPT usership just get to? 800 million?
Yeah, roughly,
No, the numbers are.
Here we go.
Compute that's going to be needed, and Ben writes has this morning in his little note from Melius in terms of Sora, for example, and the amount of compute that takes versus just your typical query on ChatGPT.
Yeah,
it's many multiples. Not to mention, obviously, so many other use cases that would even require more compute, which is why Sam Altman's out there. But it is amazing how he's been able to move away from essentially Microsoft in terms of the dependence for capital that a year ago seemed to be, they were inextricably linked.
I mentioned yesterday that David Kahn, his partner at Sequoia, who a year ago was kind of saying maybe things are going to get ahead of itself in terms of the amount of spending.
I remember that.
And he just Monday published a new piece. He said, it's got obviously multiples of what it was a year ago. And he says,
here we go.
That can justify investing at this scale is AGI, is artificial general intelligence. And so, And meanwhile, the experts kind of pushing out the date where that might actually happen. So you have a lot of front-loaded spending on maybe we have a longer timeline. Who knows if that's true? But I do think people are talking fast. The scientists are like, it's about AGI. Sam Altman, it's about AGI. And investors are like, oh, search ads, subscriptions, software licenses. They think it's kind of like we're going to get to a point when we built it, and we're going to just then harvest the network effect earnings off of it.
Yeah.
And the people involved are like, I don't know. We don't see the end.
No, I mean, and maybe it will. But that said, OpenAI, I think, is seen as, they could become
got it
a
all over the
social
web.
network. They can
Absolutely.
become, there are so many different
Hardware,
businesses
advertising,
that they're going to be able to move
Right.
into. You don't want to fall into the Amazon trap where I can remember people saying, well, they just sell books. I mean, the market for books is
No,
only
of
this.
course, yeah.
Without
Messed up, guys.
They can sell other things.
Got out way too early.
Actually,
In books,
great
tons
story
of
in
SKUs.
'99 saying, can you believe how much energy it takes to buy a book on Amazon? And we're not going to have enough energy for the internet.
Really?
Yeah, I'll show it to you.
Okay, show that to me.
Meantime, S&P falls into the red early going here. Dow's up 50. We're not going to get claims today, obviously. Not going to get wholesale trade as the shutdowns in day 9. Yields stubbornly stuck to 4.15 on the 10 and almost 4 3/4 on the long bond. Stay with us.
Yeah, the Nbhd went, boys. Check this out. Bought the break and retest of all-time high and sold way too, or sold one around here and one another here because I saw this pullback on the daily chart trend line. And look what I missed out on. I could have made like $400 instead of 100. and 36. But, well, now it's gone, so you can't really chase that anymore. Wow. Worked like a charm. Worked like a charm, guys. Nbhd trade is done. Let me focus on here. Got 2 puts here with a stop up above 95. 95.25 sounds good, like a stop. $282. That gotta work out, huh? Let's see.
Welcome back from global gaming to the NBA returning to China. High-stakes bets are reshaping Macau. Contessa Brewer is there, and she joins us live right now. Contessa.
Hi there, David. Behind me is the Londoner. It's the big rebuild and rebrand by Las Vegas Sands on the Cotai Strip in Macau. A more than $2 billion investment with lots of focus on non-gaming amenities. And Sands, just like its competitors here, have committed collectively to spending $15 billion over the next decade, with at least 90% earmarked for non-gaming amenities. And look, these are impressive. For instance, let me show you. MGM has a jaw-dropping spa experience that makes clients feel like they're riding out a thunderstorm submerged in the waves of the ocean. That spa remodel entirely cost $7 million. Macau's government is working to shift the economy to a broader tourism and entertainment destination, and that appears to be working. Visitation is on track to hit about 39 million people this year. But look, it's not the spa that fuels the profits, it's the gambling. I asked executives leading Sands, MGM, Melco, and Wynn about getting a return on their investment here, and every one of them tells me the gamblers are the priority. But now, post-pandemic, they're coming to the destination with their family or their friends for the amenities, and that is a real shift here. Citigroup published a note just this week raising its expectations for gross gaming revenue for Macau this year to $33.3 billion. That's up 10% year-on-year growth, up from their previous target of 7% year-over-year growth. And over the last 6 months, what we've seen is shares of these companies have soared both on the U.S. exchanges and on those traded in Hong Kong. Really, this is the optimism over capturing the imagination, maybe more importantly, the cash of these Chinese consumers, guys.
And Contessa, what venue principally is the main competition for Macau as they try to kind of expand this sort of local franchise and draw more people for both gambling and not gambling? Is it other gambling centers in the rest of the world? Is it just alternatives in the region?
That's a great question. Singapore drew a lot of business from hardcore gamblers away from China when Macau's borders were shut for the pandemic, and they stayed shut a long time. There was a lot of talk about the high rollers, or as you might have heard the term whales, going to Singapore or to Malaysia. So for instance, Sands, which operates the most lucrative casino in the world at Marina Bay Sands, was the beneficiary, even if they were losing business here in Macau. That appears to be largely resolved. I asked specifically about those high rollers and whether they've returned, and the answer was a resounding yes. But now you have all of these younger Chinese clientele who have discovered not just the gambling, they've seen on Instagram the Michelin-starred restaurants or the golf course, and the sporting events and the concerts, analysts say, that is drawing a crowd who then gamble.
It's really good to have you there. Interesting pictures, Contessa, as well as the information. I know time difference means it's a little late. Hopefully we see you again today. Contessa Brewer in Macau. Mike, thank you for joining us this hour.
Absolutely.
Appreciate the help. Coming up in the next hour, Pepsi's Ramon Laguarta on his company's quarterly beat, growth, strategy, and the consumer as the S&P joins the Dow in the red.
Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber live at Post 9 from the New York Stock Exchange. Today, mixed bag for PepsiCo, the company topping estimates, but global volumes fell in the quarter. We'll talk to the CEO, Ramon Laguarta, about what he's seeing from customers around the world right now. Plus, Ferrari shares racing in the wrong direction this morning as the company gives guidance that disappointed analysts. We'll talk about the specific number that is spooking the street. But guys, the big story is still this government shutdown and the fact that the Fed is now flying blind into its October meeting because we're not getting the official data releases. It's an especially uncertain time for them. We got the minutes yesterday from the last Fed meeting, the notes from last Fed meeting, and while it seems like most of the members want to keep cutting, there's still some members that weren't so sure that a cut was the right thing and would have been in favor of staying. In other words, there's a debate and there's a discrepancy, and they're highly data dependent, and we're not getting data. So what we've been doing
I'm
is
out
trying to get some
because I think I'm going to prepare for a long soon.
real-time indicators from
If
the banks
there
or from
is
research
one.
firms about what's really happening. So we didn't get the September jobs report, but Goldman Sachs has a jobs tracker that they look at and that they compile, and they take all types of things into consideration here, layoff numbers and private payrolls and that sort of thing. So the Goldman number is in the orange, and you can see the blue is the actual non-farm payrolls 3-month average that we have. So it's very well correlated, which is why I chose it to show today. And what it shows at the very end of the chart in the orange is that there's actually a tick up in September, and which is why Goldman is actually above consensus, expecting job growth in the month of September. Remember, it had gone down to basically negative in June, job growth, and it's been, I don't know, trickling out in the low numbers. But according to the Goldman number, it looks like we could maybe see a better number in September if the government ever reopens and we get the jobs report. So that's something maybe not to be so worried about on that front.
Yeah, well, Goldman's forecast for employment is that we're essentially bottoming out right around now.
Exactly.
They see us going to closer to 50K, 100K by the middle of next year. So they're fairly constructive, although they're still calling for 3 cuts by the end of the year.
Right. So the other piece of it is inflation, right? And do we have to worry about an inflation spark because of the tariffs or higher inflation? So here's one for you. It comes from Consumer Edge Research, which looks at all these data points across the consumer. And so this is really a snapshot of CPG, so consumer packaged goods, what we spend on food and beverages and household products in the grocery mostly, and big box stores. And they have a weekly indicator of pricing. And this is the weekly indicator. It goes up to September 28th. So CPI, which should be released next week if we're not shut down, goes up to like early October. So this is a good snapshot. And the reason I show it is because you're not seeing a spike. You know, we're not seeing a big lift, for instance, in food, groceries, staples. That's good. It's not the whole of CPI, but it is a big component of CPI, and it's where, you know, people are sensitive when it comes to higher prices. So they're just, you know, that's in the last few weeks, it's relatively stable. And that's really been the story mostly, which I think jives with the, you know, high 2% inflation numbers we've been getting. Let's see if we get another one next week.
I mean, Apollo's done some work. The diffusion, the number of CPI categories that are growing at 3% plus, that is rising. That's 60%, and the CPI is growing at 3% plus. Luckily, we have things like shelter offsetting it. But, you know, we just got New York Fed. Long-term inflation expectations were the highest in 18 months.
Yeah, I mean, the survey of expectations matters, but let's see what the actual numbers show. And let's see where the inflation actually is. Is it in services inflation? Is it in food? Like, the best thing, the thing you can say is that the disinflation has stopped, right? The disinflation that we saw coming into the year that was really giving the Fed the green light to go, and we were less worried about inflation. Progress has stopped, but we haven't really seen a big turn higher. Like, we're not above 3%. It's not spiking because of goods prices. It's just the progress has stopped, and let's see if there's pressure going higher.
You should ask Pepsi about that.
Yeah. Hey, Sarah, before we get to Pepsi, as someone who relies on data, I'm just curious, we're like a week into the shutdown. I mean, at what point does it start to impact
The economy?
No, not the economy. The ability of people to understand what's going on in terms of them, and your ability to explain it to them. Already, you think?
Yeah,
or
I mean,
maybe
that's why I'm going to these other indicators. Like, the second we miss the September jobs report, we're flying blind, right, a little bit, because the Fed is so dependent on that jobs report, and investors have been so dependent on that jobs report.
I might get if the price gets here soon, which doesn't look like it will, I'm gonna watch its behavior, and I might get more puts there.
We still got ADP, we still got,
But
you know, job
You know,
there
see,
was before the shutdown. So
might be a risky one.
you can cobble together, and we get a lot of these alternative data sources on Wall Street, and so people can put a pretty good picture together about. But you just have to assume.
Well,
that
here on the 5, this dotted line is the 5 SMA from the daily chart, which is converging, which this Thursday higher day, which was a huge inflection spot yesterday on the yesterday sections. Things bounced from here. Things really rallied from here. It's like a break retest that we just saw in Nbhd.
Company topped estimates thanks in large part to international sales growth, though global volumes fell in the quarter. PepsiCo Chairman and CEO Ramon Laguarta joins us now to discuss the quarter. It's good to have you back, Ramon. Welcome. So it's good to see you. There was some improvement that I wanted to mention in the beverage business and certainly in international. What's driving that?
International continues to be a very resilient business for us.
This might not be a good idea to short there, but let's see.
Some markets, but we've seen September coming back and very strong. Beverage business in North America, strong as well. Continuous acceleration. Pepsi brand, trademark, overall trademark, gaining volume, gaining net revenue, gaining share. Good in the functional hydration, both Gatorade and Propel. We also saw sequential improvement in our food business in North America, which is a big part of our business. Obviously, the part that has been more challenged in the last few quarters. So we feel good about the future. We're seeing improvement towards Q4. We're seeing very strong pipeline of innovation coming up with. We're seeing our big brands also being restaged.
Might have been a bad one. Let's see, guys.
So big brands that will make big changes. So feeling positive about
The balls he put there,
the acceleration of the top line and the cost restructures that we're taking.
but that might work out.
So I wanted to ask about snacks because that has been the tough part of it and what investors are concerned about. You said recently in the last few weeks things have turned up. So what is the plan there to get back to your long-term growth targets on snacks?
I think share a couple of things first. I mentioned this morning, be brilliant at the basics, executing at perfection, customer service levels, the right price point, the right execution. We're seeing improvement. We had some blips in the beginning of the year with the CP rollout. Now that is behind us. We're seeing customers leaning into our, giving us more space, giving us more support as we provide them with services. It's very strong innovation strategy, and you will see the relaunch of the restage of Lay's and Tostitos, talking more about the food in the brands, the best potato chips fresh from the farm, and the Artigraph way we make the masa for Tostitos. Those are ways to connect with consumers in a much better way. And then innovation, we have innovation in protein with Doritos protein and Quaker protein and some other brands with protein as well. We're launching a Naked, which is a brand.
I try to hold to 85.25, and then the other one I was just watch because you might fail hard.
The customer reaction, consumer reaction. So we're actually a combination of brand, combination of pricing, execution, a combination of new platforms for innovation. We're very optimistic that the Frito business will be flat or growing, towards the beginning of next year, which is a big progress for us.
I really wonder what color Naked Doritos are. It's hard to imagine.
Naked Doritos are, the same, your favorite
Yeah, my next
Very
target should be
on Elliott,
67.83.
constructive conversations
Right
so far.
before
We've had a couple of interactions with
the
management
inflation
in
point
line
of
on a main idea, which is
82.25 and
PepsiCo
the
is
5.
undervalued, and we
It's a
both believe
ballsy
that
one
with
because
price action, the company will come back.
I need price action to get really exactly close to what I feel like it should get. So
And on cost transformation, the majority of the ideas that Elliot is proposing, we have it in our PepsiCo 2030 strategy, and we're executing. So, that is something positive. There's a couple of ideas that we're going to have more, I think, mutual education as we, in the coming weeks and months. And I'm sure we'll find a way. We're open to any ideas. We appreciate any perspectives to incorporate into our strategy and make PepsiCo a great performing company, best in class in our sector. And that's what we all want, and create shareholder value. So positive so far, more interactions to come, and I'm sure we will find a way to create value for PepsiCo.
Yeah, I'm curious then what that might be, Ramon. It's David Faber. I mean, they put out, as they often do, a long report, of course, in all the ways that Elliott views your ability to create value. One thing that I think caught some investors' eyes was their contention that since acquiring your bottlers, that is PepsiCo acquiring bottlers in 2009, 2010, your North American beverage business has, they say, profoundly underperformed the Coca-Cola system and Keurig Dr. Pepper on growth and margins. Is that true? And does that put at the center of anything you might do the idea perhaps of divesting those bottlers?
David, we'll be open to any ideas. I think the portfolio is critical to our performance and long term, making sure that our portfolio is in trend with consumer, and I think that is our focus. When it comes to the supply go-to-market, which is where the refranchise comes into play, we will be open. I think the solution for the U.S. is not one solution for the whole country. It's a very nuanced solution. In some areas of the country, we'll leverage more our snacks business. Scale matters where we're small in beverages. In some other parts of the country, other solutions might be more relevant, including maybe some refranchising some territories. We're talking. We are open-minded. As I think about the future of demand, the possibilities of technology, and optimizing PepsiCo in its totality, not only beverages or snacks, I think there will be multiple solutions, and we'll continue the dialogue with the Elliott management and see what is the best. The same as with the other investors, not only with Elliott, obviously.
Is one of the options splitting the snacks and beverage business? I know that they stopped short of calling for that, but with an activist there, it does remind us all of Nelson Peltz, who was pushing Ingenuity to do that so long ago.
Yeah, we think there's even more reasons to keep these two portfolios together, Sarah. When you think about the consumption of beverages and foods and snacks, there's very high interaction. About 85 to 88%.
cut is now because I don't think this is going to reverse. Now just watch it reverse.
There's very high correlation. We see the scale of our portfolio helping us to win when we think about college and universities and hospitals and away from home customers. They see the value of our portfolio, from Quaker in the morning to combinations of food and drinks for lunch, and then during the day. Also, when you think about the scale in warehousing, in transportation, in so many other elements of our cost spine, scale matters, and the idea of is a terrible financial idea.
I don't get it why I do that stuff. Take a $4 win instead of like let it run.
Continue to create value as a combined business, from the consumer all the way to the way we source and the way we build our products. I think it's the way to run the company.
Fuck.
Real quickly, I know we're out of time, but when you talk to investors, not just Elliott, but all your investors, as you're doing right now, they use a 3-year perspective on your stock price, which doesn't look great versus the S&P Consumer Staples Index or your peer group median. So what do you say to those investors who are frustrated over the last 3 years' performance in terms of what they can expect and why you're going to get that stock price performing better?
Yeah. I think there is a great question. I think our food business has been impacted by a combination of microeconomics and health and trends that require a fundamental acceleration of the portfolio transformation. We've been working on portfolio transformation for a long time. That requires even more acceleration. I don't know if you had a chance to see our pipeline of innovation for next year. It is an acceleration. It is moving into the fast growth segments of the category where we can drive a lot of value. And it's also some of the M&A we've some parts we're going to innovate, some parts we're going to do tuck-in acquisitions like we did with Poppy, with Siete, with completing the Sabra ownership. Those give us spaces where we can accelerate growth. So I'm very convinced our food business will come back to the 3 to 4% top line that has been our aspiration, and we'll be able to right-size the cost structure and come back to the margins that are have sustainable and margins that business deserves because of its scale and its performance.
Is that combining North America, North America, combining snacks and beverages? Because I'm not sure that all investors are on board with that plan, and it also then eliminates more possibilities down the road for splitting.
Yeah, I think in some parts of the country, especially where beverages is smaller and cannot compete very well on its own, and this is some states in the South where states like Texas or Louisiana.
I'm gonna wait.
Some of the, even Florida.
I'm tempting to buy calls for the hold of 67.85, but it's so close to a good entry that my stop needs to be like almost like 5 points. So no.
We believe in that. In other parts of the country that we don't need the scale, the combined scale, because the two businesses are very competitive and very scaled. There we might approach other solutions. That's how we're thinking about it. And I think that long term, that will create the most value.
And finally, I know we're out of time, but so we don't have the official data, Ramon. So how does the U.S. consumer look to you, and how does inflation look?
Well, we don't need a lot of data. We have data every day. We see that still middle class and low class families in the United States are stretched, very stretched, and we see them making decisions to down trade or to eliminate from their portfolio choices. Things that they don't really need. So we're one of the studies, obviously we're all following the consumer industry and ourselves, is make sure that we give the consumer the right to be in our brands at the right price points, at the right absolute prices that they can afford throughout the month, beginning of the month, end of the month. We're seeing Hispanics especially hurting. We're seeing their mobility, their income, their behaviors changing a lot, and that is a consumer pool that is relevant for our brands. I think relevant for all the consumption market. So, we're concerned about some parts of the population, but at the same time, we're seeing growth spaces within our categories, mostly related to functionality, the permissibility, and the right taste, and that's where we're putting all our investments.
Judging by the the volume profile,
we're excited about
the buying was strong on the 5, even though it was almost engulfed by more selling pressure, of course, right? Prices going down. Look at the size of this candle and the volume, and look how small this candle is, and the volume is almost there. So it shows like a lot of pressure here. I'm gonna wait for. I can't buy there. I gotta wait for. Hopefully, maybe 85 is gonna hold, but
there could be an absolute number of people in the country as well at one point, and obviously, I mean, every country needs population growth to drive consumption growth, and that might be a factor going forward in the U.S. But at this point, Sarah, the issues
it's
with mobility
away from levels, but at least the 5 daily is there, and that was a huge spot of confliction right above it, 67.82. So I guess he has to hold 67.80. If he wicks 67.80, goes back up, I'll go in with some calls.
Ramon, thank you for the time today on earnings and some of the strategy and what you're seeing. We appreciate it.
Thank you very much, Sarah. Thank you.
Good to see you. Ramon Lagarta, the CEO of PepsiCo. Here's our roadmap for you for the rest of the hour. Ferrari hits a speed bump as shares pace for their worst day in years. We'll tell you why and what it says about the state of the luxury market.
Plus, is the market overestimating the Fed's rate cut plans? Former Goldman Sachs asset management chair Jim O'Neill will be with us. We'll speak to him and have him weigh in.
And the IMF's managing director says AI could be a tsunami hitting the labor market. We'll talk to one expert from Morgan Stanley who says 9 out of 10 jobs could be impacted in some way. As markets are in the red, led lower by some consumer squawking the streets. Back after this.
Oh wow! You see how I got a better entry than what the price is now, and I'm barely green. So that means there's a lot more interest on the opposite position that I have. So that's not good. By the way things are moving price-wise, I mean value-wise for the calls, I don't think there's a lot of buying interest right there. You know? That was bad. I like my position at least. See if I can ride this thing back up to at least 89. Market's trying to hold there, but I don't know, man. It does not look very good. Like, I mean, the fact that the price didn't collapse, that's a good sign. But I'm glad I waited for the touch. My feels were not as good as I thought they would be. High 86.75, 89. I'm gonna sell one at 89.50. This one we're gonna hold, boys. This one I'm gonna hold. I have to see this one through.
Welcome back to Squawk on the Street. Gold prices, we've been talking about this, of course, jump above $4,000 an ounce this week. It's a new record high, and the metal's up 50%, more than 50% on the year. Let's bring in Jim O'Neill. He's a former UK Treasury Minister, of course, chair at Northern Grindstone. Always good to talk to you, Jim. And I wanted to start off on gold just because I wanted to get your take. Like, what do you think about this move? Does it have a larger meaning, perhaps, than just looking at a chart?
Well, I think the sort of weak, superficial consensus in terms of a meaning is that it was another sign of the dollar and other major currencies losing any kind of base. Problem with that argument is that actually the dollar hasn't really fallen for about 3 or 4 months, and in fact in the past week it's gone up as well. Notably, in my view, by a surprising amount against the Japanese yen. So it is a bit of a mystery, other than to default to the probable fact that there's a huge amount of momentum in it, as there are in certain parts of the equity market. And there's a lot of investors out there that love momentum trading. And in terms of the only other substance I can think below it is probably the case that some of the very large, let's call it BRICS-based emerging countries are still probably shifting some of their portfolios from major currencies to gold, I'd guess. I mean, I don't know. But otherwise, I don't really quite get it.
Yeah. All right. Well, I wanted to put the question to you nonetheless.
Yeah, it's interesting.
Yeah.
In
No,
the
it
con-
is.
You know, in the context of this sort of also growing view that you know, maybe AI is already starting to show signs of productivity improvement, and I was online listening to some of your summary of things being said earlier. You know, there are one or two tentative signs of that, and you know, I'm not quite sure this notion that everyone's got their own goal because the world's falling apart necessarily holds together.
Yeah. Well, you mentioned AI. I certainly would love to get your perspective on that as well. As you know, we do spend a lot of time talking about it for obvious reasons.
How can you not?
How can we not? Yeah, I mean, not to its impact in the markets and the financial system, but also ultimately the impact it may have on society. But I'm curious, sort of again, as another old guy like me, you know, do you see
Patience now, you know. Hopefully this will turn around a little stronger soon, so my option doesn't lose value. But
you know, is this spend
for the
gonna have
Greeks,
a
but
return and make a lot of sense?
okay, this looking,
I have no idea.
this is looking gnarly.
Yesterday afternoon,
But should start often best positions, best entries usually sometimes can look gnarly at first and then provide a really good bounce. But let's see.
idiotically bright.
And Q's not acting right.
Kind of joked as to have no idea why I've been asked to talk to you. But then I kind of made 3 points that certainly if you look at the performance of equity markets and obviously where the leadership is, but here's the additional point. In addition to the marginal employment data that's now showing more signs in a number of advanced countries, I think you can start a narrative that there might be something going on in terms of AI, what economists would call is sort of diffusion out to beyond just the fact it's being built all over the place, but to actually people are using it to help boost productivity. So I think there were some very, very sensitive signs of that. The second thing I added is I hope that is the case, because obviously the equity markets seem to be...
Volume profile on the 2 minute. Lost a little steam on the selling. Let's see if the sellers are exhausted. The buyers will step in right there on the 5.
And then the third thing I said, which I think goes to the core of the deep part of your question, is
Yeah, this setup could be better. You know, if the 5 was converging with the demand level and the trend line, that would be a way more powerful entry. There is like a 5-point divergence from all that, so that might not work out. I'm gonna de-risk a little bit.
Sort of being allowed to go on by all sorts of societies if we still have so many people feeling disgruntled about not sharing any of the pie. So
Yeah,
I actually wrote something about it at Project Syndicate a couple of weeks ago.
Are you there? Oh,
Kind of breaking up to me a little bit there. Sorry, repeat the question.
you're back. You're back, Jim.
Yeah, I'm here.
It's Sarah. Hi. My question was actually on. Hi. It's always good to talk to you, and you know a lot about central banks, even though you're always very self-deprecating on all these topics. But on the Fed, so the Fed doesn't have the data now, and the question is it going to cut rates more, 2 more times this year, a bunch of times into next year? There's a big leadership change coming at the Fed. Next year, I noticed that Secretary Bessent did a community banking event with Michelle Bowman, the Fed governor and vice chair of supervision at the Fed this morning in Washington. In a roundtable discussion, he was very pro-community banks and even talked about them getting into crypto. But I'm just curious what you think is going to happen with Fed policy amid all of these, first of all, changes in the economy with regard to AI, but also as we try to figure out what's exactly is happening on jobs and inflation.
So I think the challenges for the Fed get tougher, in my opinion, because if we are getting further or a pickup in productivity, then that in itself would mean the Fed probably be less concerned about the employment softening, and therefore less need for...
Okay.
But of course, there is also simultaneously this very complicated analytical challenge going on about whether immigration is really curtailing the labour supply, which obviously, if true, are not being compensated enough by the AI productivity.
Okay, that was fucked up.
Some people at the Fed,
Gave $50 back. I think I'm just gonna chill now.
being lowered by, ironically, the success of the immigration control, and that would certainly make the Fed more cautious about cutting rates, unless the core inflation data actually really starts to improve. Everybody seems to behave as though inflation's way past its troublesome times, but core inflation is not really coming down. And from my sort of cursory analysis, when you delve, it does look like it might be creeping a little bit higher. So with the markets having this very confident expectation that the Fed's going to do, considerable moves, and partly because of the pressure from Scott and from obviously the president, those are things that I think have to be looked at really carefully.
Jim, always appreciate you taking some time with us. Thank you.
My pleasure. Thanks for having me on, guys. Good luck.
Busy morning as Delta reports earnings, Novo makes a deal, Tesla gets hit by this new safety probe. We'll get some morning movers to watch after the break. Speaking of movers, watch Ferrari. We mentioned shares hitting the brakes as this new long-term guidance disappoints. We'll get details on that in a moment. And is AI the biggest risk to labor markets right now? We'll get Morgan Stanley's take fresh off a new report arguing that 90% of jobs will see disruption. Don't go away.
I'll try to build this position, guys. Very optimistic, but you gotta get 67.80, gotta get 67.82, and then maybe break and retest and go long again. Then I think it's gonna look good it's gonna look like he wants to reverse. So I'm gonna try to build a position right there for us. If it makes a new low, I gotta get out. And then I just stop trading, call it a day, and go fucking sleep a little bit. Finding the trend, man. Last try.
Just over 30 minutes here into the hour. Here are three big movers we're watching. Novo Nordisk announcing plans to buy biotech company Akero Therapeutics. It's more than $5 billion deal. The biotech company says its metabolic dysfunction treatments will complement Novo Nordisk's GLP-1 treatments. Delta in the green after its profit forecast topped estimates driven by higher airfares and resilient luxury demand. CEO Ed Bastian telling CNBC earlier this morning that the shutdown hasn't impacted the company's operations. Also, Tesla under pressure after the NHTSA said that it's opening an investigation into more than 2.5 million Tesla vehicles equipped with their full self-driving.
Why am I still convinced that I can catch this bounce? That is kind of crazy, right?
Including 14 crashes.
Fighting the trend. I can't be fighting the trend. I do that all the time, but I'm just kind of like plant a seed for a nice reversal if it happens, and if he holds against, if he reclaims the 5 and then keeps going up, I'm going to add to a reclaim of 92 and then probably make some good money back, you know. But I gave like 60, 50, gave like 35 to 40% what I made back already. So this, if this fails, I probably just should stop, because I feel like my ability to judge setups are not very, you know. But I have this idea that this could bounce, and then I will add on 80 or around here if it wicks down and reclaims it. It got to look good. Let's see. So far, it's still looking bad. Let's see. Got to make a new high. 80 right here, 79. This is 80. Okay. Yeah, we have a huge situation there to clear. But I've seen it happen.
To purchase up to 4 icebreaker ships from Finnish shipyards. Trump has previously called on the U.S. to acquire as many as 40 icebreakers to counter Russian and Chinese influence in the Arctic region. Carl, I'll send things back over to you.
Tom, thanks. Ferrari shares are in reverse today, plunging after new numbers out of the automaker. What that says about the luxury consumer when we come back. Plus, Morgan Stanley's predictions for how AI will disrupt where, when, and how we work, as they warn 90% of occupations will see an impact. When we're back in a moment.
Not losing a lot of value, which makes me feel confident it still can bounce. Wow. Wow. Yeah, market's puking, guys. Okay, I'm done. I'm done trying to fucking fight this shit. Wow. Fighting the trend, dude. That's what I've been doing. Ha! Look at us. Wow. Wow. Yep. Just took me out. Wow. If this does exactly what I was envisioning, it's gonna be very, very traumatic. Wow. Bought the top, of course, right? Let's buy the top and see what happens.
Shares of Ferrari down double digits after disappointing long-term guidance. Let's get to Robert Frank with some of these numbers and what they're saying about the EV market, among other things, Robert.
Yeah, Carl, good morning. Ferrari shares down 13% on fears of a slowdown in profits. At its big investor day today, the company raising its short-term guidance, but it lowered its long-term projections, and that's what really got investors concerned here. Analysts had been expecting EBITDA growth of about 10% a year, now looking at more like 6% through 2030. The company also scaling back its electric vehicle ambitions. It released the details of the technology, at least, that will power its first all-electric Ferrari. That's going to be launched later next year. That car is called the Electrica. It's going to have special motors generating 1,000 horsepower, 0 to 60 in 2.5 seconds. But it lowered its EV target, so it said EVs would account for 20% of its lineup by 2030. That is down from the previous 40%. You look at other high-end sports car makers, they're also delaying or throttling back their EV plans, from Aston Martin, Lamborghini, Bugatti, all sort of dialing back those plans. In its earnings call in July, Ferrari said that there's no indication that tariffs are impacting demand at the dealership. Most of its models are sold out. The waiting lists are over a year. So guys, this really isn't a story about the wealthy pulling back or any signs of less demand. It's really just probably a conservative CEO that likes to underpromise and overdeliver. This is a stock that's so highly priced, very expensive at 40 to 50 times. Any whiff of slight uncertainty tends to really affect this stock, Sarah.
You know what else is not working? Their F1 team, not so hot lately either. Thank you, Robert. Robert
Not a
Frank.
good year for Hamilton yet.
Exactly. After the break, Morgan Stanley's take on how AI will change labor markets across the globe and which industries could face job cuts. Stay with us.
God, I you guys gave all my profit back. Wow, this is embarrassing.
developing frontier models are going to apply about 10 times the computational power to train the next model later this year and early next year. And researchers do expect that to result in not a little improvement, but a fairly massive improvement. So the analysis that we performed over the summer, I think, will look very different as we head into 2026.
Yeah, if scaling laws hold, I guess, is a key uncertainty, isn't it, though? At this point, Stephen, I mean, do you expect that? Do we even know? And does that make so much of what you can predict uncertain?
Great question. This is unknown territory. Even the best researchers in the AI community would admit that it's unknown territory. What I would say is when you look at the research being done by a number of teams, there was actually a great paper from a team from Meta last week on this in terms of scaling limits. It looks very promising. And, an example, just in the last couple of weeks, a couple of models scored a gold medal on the International Math Olympiad. This past weekend, a couple of world-class physicists, mathematicians, computer scientists are now using AI to really enhance their thought process. Now, that's a sign of where we're heading in terms of further creativity that AI can accomplish. I do think back to the game of Go years ago where AlphaGo achieved this breakthrough. I don't see a limit, but again, we don't know, and this is a key uncertainty. You're absolutely right.
Wow.
And so, all right, is there a point at which we will know? Or, can you give me some date here where you can come on and we can have a lot more certainty about the predictions and what we're seeing and how to approach it?
Yeah, I really think we can in the sense that by the spring or early summer, the models that have been trained on about 10 times the compute will likely be revealed. And at that point, we will see whether or not all of this compute has resulted in improvements. Now, what gives me hope here is that when we look at the test results, that is these incredibly difficult
Wow,
tests
guys, this is funny.
For much of this year, they were scoring fairly low. And then over the last couple of months, a handful of models achieved pretty big breakthroughs in those incredibly difficult tests. So I am optimistic that we'll see continued breakthroughs in terms of performance.
Yeah, that is interesting. The idea that we're in the middle of a step function, literally in the coming months, according to some of your work. Stephen, hope to have you back. Appreciate it very much. Stephen Bird over at Morgan Stanley today.
Well, coming up, we'll have a look at the surprising new investing strategy that is gaining steam apparently with millennials. And take a look at shares of Oracle. They're up over 2% this after a bullish initiation from Baird. By the way, don't miss an exclusive interview with Oracle's new CEOs, Blaine McGurk and Mike Cecilia. That's going to be live from Oracle AI World in Las Vegas. Monday, it'll be in the 11 a.m. Eastern hour. We're back, Red.
Finally bounced. Finally bounced.
traditional 60-40 portfolio of stocks and bonds has been one of the most widespread investing strategies for decades. Millennials are opting for a different approach. Leslie Picker here is here to tell us what that approach is. Leslie.
Yeah, David, apparently stocks and bonds are for boomers. Millennials are way more invested in alternatives than the older cohorts. The generation with birthdays between 1981 and 1996 has about 20% of their portfolios allocated to alts, areas like private equity, venture capital, and private credit. That proportion is double that of Gen X, boomers, and the silent generation, according to the results of a Goldman Sachs survey of 1,000 high net worth individuals. Millennials are also shunning public equities relative to older cohorts, with just 27% of their portfolios in stocks, compared with nearly 50% for baby boomers. In fact, 54% of millennials surveyed perceive alts as the best exposure to growth industries, a response to the disappearing number of public companies and startups staying private for longer. This generation, of course, came into adulthood during the internet and now AI booms, enriching many of their tech-savvy peers. Millennials were also early in their careers when the financial crisis struck, which may have something to do with why they perceive equities to be riskier than older generations as well. And as we think about our role in the media, the survey asked respondents how they get information about alternatives, and the number one answers, financial TV news.
Really?
Pat on the back there. I know, I was surprised by that too. But yeah,
It's encouraging.
important role there.
It's encouraging.
Which is why it's so important that you're covering it actually on CNBC.
Yes, because there is one of the big complaints about alternatives is that there's just a lack of information, a lack of transparency. Millennials are clearly more comfortable with that, but they're getting their news from the media far more than any other source, including financial advisors, by the way.
Right. Now, also used to be a lack of liquidity. There are any number of different products being constructed that are going to create at least some form of liquidity, not necessarily on a daily basis, but do they understand what that means?
Yeah, I mean, in terms of their understanding of the liquidity element, of just the overall information asymmetry element, of the fee element, those are all complaints that people have made about why not to get into alternatives. It seems like at this juncture, millennials are just more comfortable with that notion than the older generations, and they even perceive equities, which are liquid, to be riskier. So, I mean, I think liquidity itself is not an indicator of why they should shun a certain asset class over another one.
Right, and that's before any of this broader exposure has been formalized.
The 401ks.
Yeah, exactly.
Exactly, and it also has implications for just the next marginal buyer as these generations continue this shift. If it were to continue, what does that mean for stocks? If
Right.
the marginal buyer is far more invested in the private markets and the public
No,
markets,
marginal
who's buying
buyers
stocks?
are good. We like marginal buyers.
We do.
Yeah.
Yeah,
Well, good thing there's still a lot of boomers out there.
exactly. Thank goodness for the boomers.
Leslie Picker. Coming up next on Money Movers, gold and silver hitting record highs as investors rush to safety. The CEO of Wheaton Precious Metals with us to discuss just how far this rally can run.
I was right the whole time.
Good Thursday morning. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, ceasefire after 2 years of war. Israel and Hamas agreeing to the first phase of a U.S. brokered deal. How investors should navigate the geopolitical implications.
Gold's record rally holding above 4K, while silver also hovers near the highest level since 1980. We're going to be joined by the CEO of Wheaton Precious Metals this hour.
And at the center of D.C.'s shutdown fight, now in its second week, healthcare. We'll discuss how the sector is already being impacted and just what the protracted fight could mean for your premiums, other implications in the near future.
A little bit of selling on this Thursday morning. Dow, which is already down 3 straight, continuing that trend. S&P joining it down about 0.2%. Consumer discretionary is the standout, down a full percent this morning, and that's going to take the XLY back to the lowest level since about the beginning of August.
We'll start in Washington. Comments from the Treasury Secretary regarding the banking sector. For that, let's get to Steve Leisman, who's been following it. Morning, Steve.
Hey, Sarah. Yeah, this Treasury Secretary doesn't mince words. Scott Bessent making some sharply critical remarks about the 2010 Dodd-Frank Banking Reform Act and promising sweeping deregulation to help stem the decline in community banking.
The post-crisis framework has left a trail of destruction in its wake by reinforcing the larger economic dynamics that have hollowed out the American heartland while enriching the money centers in coastal cities. To be clear, the financial crisis underscored the need for new regulations. The purpose of Dodd-Frank was to end too big to fail, but it ended up creating too small to succeed.
Speaking at a banking conference at Fed headquarters here in D.C. with Fed Governor Michelle Bowman right next to him, Bessent noted that the 3,600 community banks have disappeared since the act was enacted. The industry has lost market share and new applications have fallen into the single digits every year. He says a reform should include improving the rating system, monitoring the examiners, and improving the appeal process for those examiner conclusions, and reducing roadblocks to innovation. That's a key. The regulatory burden has definitely increased, but small banks have been given some relief. They face stiff challenges from new players and new technology, so it's unclear if further regulatory relief turns this tide. Separately, Bessent said the U.S. deficit will be lower than expected this year, in part due to tariff revenue. It's going to drop from an estimated 6.5% of GDP in 24 to an estimated 5.9% this year. However, guys, the actual report's going to have to wait until the end of the shutdown. Guys?
Steve, as for Bessent's comments about the banks, I mean, if the market is expecting smaller or regional banks to get more love, it's not really apparent yet. The KRE's almost at a 2-month low.
It's interesting that the market did not react to this. I think there's a couple things. First of all, it's interest rates that are part of the bigger part of the evaluation equation when it comes to the smaller banks. But also, I think, Carl, it may be one of the things, show me what regulations you're going to pass, and let me work out what's going to happen. Because of these other challenges, you guys every day are reporting about the amazing innovations in the financial industry. And not to disrespect community banks, but I'm not sure those leading edge innovations are coming from the community banking sector.
But certainly getting low. I mean, I think that Governor Bowman made the point multiple times that it's the first time she's seeing a Treasury Secretary engage on community banking. Sort of Main Street Treasury Secretary.
It's an excellent point, Sarah. His presence at that conference, his very strong words about it, and obviously a laundry list of important promises that could help community banks. But it's been out there for a while, and you have to sort of step back and say, okay, what's the investment proposition here? Is my money better off at the leading edge, some of the crypto finance that's going on, some of the AI-led finance innovations that are happening, or how can community...